Hello everyone, welcome to our Egyptian online seminar group. First, keep your phones off. Then, if you have any questions, you can ask our speaker during his presentation or after his presentation. I have great pleasure of welcoming dear Professor Alvis Lo. Alvis Lo is an associate professor of accounting at Boston College. His research interests are in the areas of banking, debit contracting, and financial reporting. He is also interested in the determinants and consequences of financial misstatement and earning management. His research has been published into banking journals, including Contemporary Accounting Research, Journal of Accounting Research, Management Science, and the Accounting Review, and in the media such as the Wall Street Journal and the CFO magazine. Alvis currently serves on the editorial board of the Accounting Review. Now we will start our seminar with dear Professor Alvis Lo.
Thank you so much, Mohammed. Very happy to be here to share my research. So let me start sharing my slides first, and then I will talk about the paper of today. And thank you for all of you for coming to see the presentation today. Uh, let me open this. And then here. Can you all see the screen? Perfect. And thank you again for coming to the presentation. I know now is almost evening time in Egypt, and you guys are still, coming here. That is really my pleasure of sharing my research. So this paper is with my colleagues, Carlo Galiberti and then Eric Jesselman. Um, so in this paper, what we are interested in is on how corporate disclosures, if they are disseminated and distributed in the capital market, are there any impacts on the cost of bank funding? All right, so I will give an overview of the research question, what I think this paper can contribute to, and also I focus on the main mechanisms and then show you some of the key results of the paper. If you have any questions, any comments, any suggestions, please raise them anytime. Okay. Thank you so much. So if you try to think about the world where companies are getting money for their projects, right? And I was talking to Mohammed earlier when we were, chit-chatting about, this particular workshop, online workshop. In fact, like he's now a banker. So I was asking him about, the banking system in Egypt. It's not different from the other places in the sense that bankers and companies, they always have close ties with each other. Banks are a very, very important, fund suppliers around the world. And also, in the Egypt setting as well, like you have, some of the biggest banks in the whole continent, right? But some of you might be surprised if you're not familiar with the US setting. Because the US setting, if you think about the US markets, a lot of people, every time when turn on the news, people will be thinking about the public capital market, New York Stock Exchange, right? All the news about, all the headlines about the capital market. But something that might not be well appreciated sometimes is actually banks are a very dominant funding source, even in the US, right? If you try to look at some recent statistics on the total proceeds raised in the different markets, right? If you look at the stock offerings or the bond market, even in combination of the two big markets, right? The funding provided by those markets would not be as big as the syndicated loan market. And I'm not even including some other, corporate lending here as well. Here, I'm only including the syndicated loan market. So bottom line, banks are very, very important fund supplier for corporations. The main thing about banks as a fund supplier, there's a very clear distinction between them versus the public capital market. As early as 1939, the well-known economist Joseph Schumpeter already write down something about the banker. How do they resolve information asymmetries, right? They have to know the transaction very well. They had to know the customers very well, and that's confirmed by Mohammed in your day in, day out, corporate life, right? You contact your clients all the times and try to, maintain close ties with them, right? So Joseph Schumpeter is also saying that, well, the bankers know their clients very well, even their private habits, right? And how do they do that? They get that by frequently talking to them, frequently communicating with them. So private debt is featured by private communications. People have very close ties. People talk to each other all the times. People share information because that's the way to resolve information asymmetries in this setting. That's what we know from the daily practice and then the prior literature. Versus what we all know is very different in the public capital markets. Public capital markets are much more about public disclosures. The stakeholders have they have an arm's length relationship with the corporation. They rely a lot on the public disclosures to get information about the firm they are interested in. So these are very distinctive features of the two markets, and we all know that very well. And these features are part of the main features that the prior literature, the economists, they highlight as the distinctive features of the system. They even say that the two different capital market system, right? They can be competing models of capital allocation because they use different ways of resolving information asymmetries. They deal with how to channel the funds to the corporations in a very, very different manner. So people try to study what will be the efficiency implications and things like that. So my paper is not on those issues. My paper is much more about, while there are so many papers on how these two capital market settings are competing, we are more interested in the potential interactions between the two, in the sense that we want to focus on whether there are any spillover effects from the regulatory intervention in terms of how disclosures are being disseminated in the public capital market, whether there will be any spillover effects on the private debt market. So I think there are two main things in the paper or specifically about this research question. From the perspective of understanding the economic consequences of public disclosures, I think we can highlight, some additional consequences of public disclosures, right? This is important given how big the amount of ban lending is in funding corporations, as we saw earlier. And also from the perspective of understanding the two markets here, while a lot of people highlight that they are competing models of capital allocation, we do want to highlight that there might be some interesting interaction between the two, from a disclosure perspective. There could be some disclosure spillover effect from the public capital market into the private loan market. And that is some sort of interesting interactions that we would also like to highlight. I'm going to talk about the potential economic mechanism that we focus on underlying this particular disclosure channel and underlying this particular spillover effect. And I will also give you an overview of the main findings before I get into the research setting, how we tease out the particular spillover effect, what main findings do we find, and I will conclude. All right. Again, if you have any suggestions, any comments, please feel free to jump in anytime. Very looking forward to that. Okay. The economic mechanism that we want to highlight is through this credit assessment channel because we know in order to issue loans from the bank's perspective, they need to assess and evaluate the borrower very diligently. But in this very competitive world, right, bankers do not have a lot of time to do that. Some practitioners are even saying that, well, we have so many clients and we have to compete with so many, banks out there. Sometimes the banks will only give me as few as 2 weeks to do the due diligence. And I'm just really struggling and hoping everything will turn out all right. So speed and working on tight deadlines is one features in the US syndicated loan market. Okay. And you might think that if private communication is really the defining features of the bank lending, right? There would be probably no impact for the dissemination of the borrower's disclosures, right? Because without easy access of the disclosures, banks can always try to ask the borrowers to give them the information, right? Just pick up the phone, make a phone call to the managers of the borrowers, right? They will give you all the information the banks need, right? And borrowers will have incentives to do that. If they want to get the loan, why wouldn't they give you the information, right? So it's possible that there will be not much impact if we're looking at the borrower disclosures. Even if you try to make it easier for the public to get the information, there might not be too much of an impact. And this is like there is a strong notion about this particular thing in the literature as well. Private communication is so important. So a lot of time, if you think about the disclosure piece, the impact on the borrower side, there might not be too much impact going on. But one thing that we think could be important and useful to think about is if you think about the information flow in the public capital market, you can also think about, all the other firms related to the borrower, their peer firms, if they are also disclosing, right? And if the information flow coming from the peers is much more smooth and they can get to the public audience, including banks, much more easily. There could be some benefits if the banks can learn from these other borrower peers disclosures. And this is like the peer disclosure effect that we are thinking about. Again, we focus on whether if we increase the dissemination, the distribution of the disclosures, including both the borrower and the peer, okay, whether there will be any impact on the bank's assessment of the borrower's loans, okay, and then we focus on the loan cost. For those who are not familiar with the credit risk assessment, I will start off with the credit risk assessment 101. I don't claim that I'm an expert because I know Muhammad, you are the practitioner, you are a corporate lending banker. So correct me if I'm wrong. All right. So this is a credit risk assessment spreadsheet. I just took that from, you can easily get that from, online. I just took this from Liberty and Peterson. They have they have a paper talking about the credit risk assessment and other things. All right. So usually people start off with understanding the industry, whether the trend is going well, how about the output, the earnings, and the lenders will try to rate the borrower in terms of the industry overview. Is it good? Is it in a declining mode? That kind of things, right? But if you try to think about industry, analysis in here, the peer disclosures would have a lot of information in there that provide rich discussions about the macroeconomic market and also the risks of the industry that the firms are facing currently, and then also what are some of the key key innovations and developments in the market, things like that. So what I'm saying here is, if the banks are trying to see from the firm's perspective, how they think about the industry, they can get a lot of information, a lot of new perspectives from the disclosures provided by the firms in the industry. And they can combine these sort of new insights and perspectives from the peers with what they know about the borrower to more precisely assess the borrower's credit worthiness. And also sometimes, the borrowers will give the internal projections to the bank in order to assess whether these projections are too optimistic or realistic, right? The peer disclosures can provide them with some insights. They can use that and see, hey, are they supported by the current market conditions? So this is like one way we think, my colleagues and I think, there will be some benefits from, for the banks if they can get the PA information more easily. And that we term as, part of the spillover effect coming from the public disclosures. Okay. If you try to think about the item two, like just now, it was like the item one, banks will have to, understand the industry conditions. Well, a lot of time they also need to rate the competitive position of the borrower in the industry. Are they doing well? What is their market position in terms of cost, in terms of the revenue, in terms of their earnings? Are they a leader? Are they at the bottom? So benchmarking is also something important for the banker to rate in order to understand the competitive position of the borrower in the industry, right? And then what we're saying here is, well, in order to do this benchmarking, a lot of times, you need to know the peers, because otherwise, where do you get the benchmark, right? Where do you get the comparison? And increased dissemination of the peer disclosures can help banks to put the borrower's performance in perspective, right? How do they do compared to the other firms in the industry? So this is another way that potentially the disclosures can help banks to understand the creditworthiness of the borrower. All right. There could be other ways as well, but we focus on these two and think that if the disclosures are helping the banks to understand the borrower, okay, then banks might not have too much uncertainty about the borrower. They can price the borrower based on the performance a little bit better. They can, expose after the loan, right? They can also use the protective terms such as covenants to monitor the borrowers a little bit better. They can write better, potentially better loan contract. So with all these sorts of potential benefits, we are predicting that banks might try to lower their price protection. We make two specific predictions for the price protection piece, and then we will also look at how the change in the dissemination of disclosures could have an impact on the other loan terms and the way that banks are pricing loans in some additional tests. But for the main test, we focus on the price protection part, okay? On the part of the borrower disclosure, if we try to make it easier for outsiders to access the borrower disclosures, we think there might not be too much activities going on because, as I said, right, bankers can always try to get information privately, even without the public channel. But the peer disclosures might not be the disclosures that the bankers will be easily, would be able to easily obtain. So increasing the dissemination of the peers disclosures in the public capital market can potentially help banks better understand the borrower and lower the price protection that they would demand in writing the loan contract. So that is the prediction we have for the main test. As I said, we also do some additional tests looking at the other terms and the way of pricing as well. All right. So let me give you the main findings. So before I talk about the main findings, just wanted to know, are there any comments, questions, or things that I would need to clarify before I move on? Please feel free to jump in anytime, okay? All right, if this is this seems to be okay. You're happy with the economic story we are looking at. Let me talk about the findings we have. So for those of you who are not familiar with the US setting, well, in the US as with many other countries as well, now in the modern days, right? We can easily just like go to the internet, click on the regulator's website, and in particular in the US, you can click on the AGR website, right? You can search, and then here I just search Boston beer, and then you can find a lot of the disclosures. All right. This is our setting. We are using the staggered adoption of AGR as the setting. That's rolling back in the 1990s. All right. We are using this to try to tease out, okay, if we increase the dissemination of the disclosures in the public capital market, whether that would allow banks to assess the borrowers and how would that affect the loan cost. All right, I saw one comment. Is it a question or? Okay. So if you have questions, try to jump in anytime. You can unmute yourself and I can answer your question. All right. Um, and then we looked at the increased dissemination of the borrower disclosures. We don't find much activities going on. But if we are looking at the increased dissemination of the peers disclosures, we do see that that change has, an impact on the price protection. Basically, we find lower price protection demanded by the banks. And then in terms of the additional effects, we find that the change in the dissemination of the disclosures has an impact on how the banks will price the performance of the borrower. This effect is somewhat nuanced in the sense that it can increase or it can decrease the loan cost. So ultimately, we don't know what the overall impact is. We do see that price protection goes down, but then in terms of the pricing of the performance, sometimes that can lead to higher costs, sometimes that can lead to lower costs. We also look at the other outcomes in the sense that, our banks use covenants differently, and things like that. And I'll talk about that later. Okay. Let me talk a little bit about the research setting, and then I will go over the research design, how do we tease out the particular impact that I was just talking about, and then I will conclude after that. Okay. As I said, like if you're not familiar with the AGR setting, this is like what happened back in the 1990s. All right. So before AGR was effective, before it became so convenient for us now that we can just like click on the internet to find the filings of the companies. In the past, is a very different story, right? If you wanted to get the copies of the copy filings, you actually had to make a physical trip to some of these like public libraries, either in DC, Washington, New York City, or Chicago. You had to fly all the way to the cities and then try to obtain the filings in the library. And even if you're willing to make that such a like investment, you might not be able to find them because like you had to compete with the other people, other readers who are also looking for similar copies. And sometimes like, these copies might not be in the place where they should be. And they might be even stolen, right? So that's why there were like a lot of inconvenience at that time. Okay. Um, you might think about, are there any alternatives, right? One alternative is, well, especially for bankers, right? They might try to call up the company and try to get the filings from the company themselves, right? Call up the investor relations and try to get that. But this might be impractical for bankers who are working on very tight deadlines. Like, as I said, due diligence usually takes at most like 2 weeks, right? So you have to wait, and then if you want to get multiple copies from different peers, it's even harder, right? It really depends on your luck. So it's not very practical in that sense. In the sense of, are there any private data providers? Given that how cumbersome it is to get the AGA filing from the public sources at that time, yes, the answer is there were different paid services that you can do. All right, so you can try to subscribe to them. You can try to get the copies from them. But one thing that is important to recognize in here is that we're talking about deals, right? People are playing the money. So the bankers, the petitioners, they know that a lot of time they need to gather the information directly from the source because they don't want to have any errors. If they have any errors, then the lender, the loan officer will be in trouble. So they have a tendency not to get the information from a third party. Even if they want to get the information from the third party, okay, let's say the third party actually provide the original copies, right? A lot of time these sort of third party providers, they only gather a subset of the filings, maybe only 10Ks or some of the more popular filings. They only focus on a subset of companies that they are interested in. Right? Because it is costly for them to gather the filings for all the companies, right? Also, a lot of time they provide the data with significant production lag because it takes time to gather the information. Let's see what the industry observers know during that time. They say that these sorts of problems are inevitable. Why? Because they have to manually collect the documents in paper. And for each one of the copies, try to transfer the information into machine readable format. And this is like a very time-consuming process at that time. And the industry observers also note that, right, well, if Agger is operational, the online services like, let's say, Me Data Central and other company providers, they can easily purchase the documents on tape and load them directly onto their system. And the lengthy processing of the paper filing and then the optical scanning, all these sorts of lengthy things can be eliminated, right? So, good news for the petitioner, right? If Agger is operational, and this is what we are seeing today, right? The SEC described the Agger has brought, significant big changes in the ways that stakeholders can get information about the companies. Easily available, right? Like you can find almost all the filings if they are made public. You can find all of them, right? You can search, lots of companies, different companies, not just like restrictive to just certain subset. So the information set coming out from the public will be much bigger. So that's what we are utilizing in our setting. The benefits that I was talking about earlier, it was mainly fully realized in 1995 because that's when the SEC took responsibility to distribute the electronic filings online. All right. It didn't happen until end of 1995. But in terms of the institutional background, something that I do want to highlight is before the SEC set up the website, distributing the filings online in 1995, there were different ways of getting the electronic filings from different sources. All right, so from 94 to 95, there were some sort of public services organized by this non-profit organization, IMS, together with NYU, so New York University. They team up together. They got some funding from the government, and they try out this free online services. And it was a success. A lot of people downloaded information from their sources. All right, from 94 to 95. And I also mentioned about some third-party paid services that existed as soon as the AGA filing requirements were in place. So that happened around 93. They charge some money. Okay, the subscribers like banks, they can access the filings on AGA as soon as the companies, the registrants, the public registrants, they make filings on AGA. Then the subscribers, such as banks, they can get the information directly from these private lender, although they have to pay, right? But they can do that. Okay, so bottom line is after agar filing was happening, then the distribution of the filings became much wider, and from the public stakeholders' point of view, they can much more easily access the filing. And we are utilizing this particular feature of the setting to try to link that to the loan cost. All right. And this is just some quotes from the petitioner talking about the impact of agar on their part. So let me just read that out, and you will see the impact of agar doing to this to the distribution of the filings. So as soon as the filings are electronically submitted, right? Then they can be obtainable electronically as well. So the agar implementation really made a big difference because they can make the corporate information readily available, and that helps a lot of public parties, including the data vendor, all right, to get the information. And these data vendors were selling the information to the public, including the banks. And some other people, some other industry observers were noting that, well, by moving from paper to digital, it really simplifies the acquisition of the public filings, and it makes it so much easier for for any interested parties to do research on companies and the industry. And as I said, we were looking at these sort of features of the setting and try to relate that to the loan cost. Okay. Before I move on to talk about the test setting, just wanted to touch base again. Are there any questions, any comments, any? All right. So what I plan to do next in the next 25 minutes is to try to look at the main test and then share with you some of the results I have. All right. Going back to the setting, the SEC assigned the firms into when they implement the agar requirement. It was pretty much like random in the sense that they try to just randomly pick the firms and then put them in 10 different buckets. All right. And firms in each bucket would have to implement the agar filing at a different date. All right. This whole process took almost 3 years from April 1993 up to 1996. All right. And some prior studies looking at this setting before, they confirmed with the SEC about how they pick firms. The SEC was saying, well, we try to pick the firms randomly, except that we take into account of firm size. We want to get the small firms onto the agar phasing schedule first. And and the big firm first, and then the small firms will come later because the small firms would be given a little bit more time to catch up. All right, so firm size is one factor that the SEC will take into account in terms of picking who to adopt the agar filing system first. Other than that, then it was mostly random. All right, so the smaller firms get later, and then the bigger firms get first. All right. This sort of conditional random assignment created a lot of exogenous variation in the setting in terms of the accessibility of the filings, both at the firm level. So at the borrower level, all right, who gets drafted into this particular agar adoption depends on really the discretion of the SEC. And also depending on how many firms get phased into the agar at the industry level, at the peer information level, that also creates a lot of variation. All right, so let me just show you this graph. I'm plotting from 93 up to 96. Okay, I'm looking at on the left-hand side, you see that the industry agar adoption rate. So it goes from 0% to 100%. Okay. So for every industry in every single quarter during the sample period, we are looking at what is the proportion of the firms in that industry that has already adopted agar during that quarter. So let's say if I focus on 1994, quarter one, the quarter in the red box that I highlighted in the graph. All right. And I have 3 lines in here. The industry in the top adoption group, All right, that is the top 10 percentile. The adoption rate is almost 40%. Okay, compared to the median industry, let's say the auto industry, or to the bottom industry, let's say the hotel industry, right? The adoption rate in the top group is much, much higher compared to these other industries. So there are lots of differences in the adoption rate, meaning in terms of how many firms, the proportion of the firms that have adopted Agile within an industry, even at the same time. Because the number of firms that would get phased into Agile, that was largely determined by the SEC assignment rule, right? So you see a lot of variation, and this is the kind of variation that we exploit in our setting. All right. We try to regress that's the basic estimation model. We try to regress loan cost on the so-called peer Agile variable, the proportion of firms in the borrower's industry that has already adopted Agile by the time of the loan. All right. We also have another variable, borrower Agile, looking at whether the borrower itself they have adopted Agile or not. Okay, this is a dummy variable. The first variable, peer Agile, is a percentage variable. And then in the fixed effect structure, the first one that we include is to make sure when we compare across different loans, all these loans are issued within the same time period, which is the same within the same year quarter. Let's say they are all issued in 1994 quarter one. Okay, do we see differences in the loan costs? And are the differences in the loan costs related to the proportion of firms in the industry that has already adopted Agile? Are the differences in the loan costs related to whether the borrower has already adopted Agile or not? All right, so these are the exogenous variations created by the SEC, and we are trying to relate that to the cross-sectional differences in the loan cost. Okay. In terms of controls, because we're doing some cross-sectional comparisons, we do control for loan characteristics. We also control for the borrower characteristics, especially those ones related to firm size, because the SEC was doing a conditional random assignment. So we do need to pay attention to controlling for the size factor that the SEC use in terms of asking which firm would have to file on the Agile system. Okay. In terms of the fixed effect structure, we also control for the loan purpose, loan type, and also industry fixed effect. We can control for industry fixed effect because, as I told you earlier, the peer Agile adoption here is not an industry characteristics. Here, if you try to look at I'm plotting 3 different industries. All right. We have the industry SIC here. We have like the 3 dotted line. All right. And then the solid line. They represent 3 different industries. I'm looking at the industry Agile adoption rank. What do I mean? So here, for every single quarter, we try to first calculate the industry Agile adoption rate. What's the proportion of the firms that have already adopted Agile? We try to rank across all the different industries and see how would a particular industry rank against the other industries in terms of adoption. All right, and you can see that, let's say the one that I'm highlighting. Okay, you can see that like the relative ranking of the adoption. All right, so this is the SIC 70, that industry. All right, sometimes it can be very low, some other times it can be very high, relatively speaking, right? So from in 1993, this industry was ranked bottom. But then later on, when more of the firms in the industry has already adopted Agile, you can see that this industry has an adoption rate that is much higher than the other industries towards the end of 93. And then it drops to 94, and then in 95, because other other industries, they have a higher adoption rate at that time. So in terms of the relative ranking, right, that goes down. So this also, you see the relative comparison of the egg adoption at the industry level, it varies all the time. And that's the point that I was trying to make, right? An industry can have relatively high adoption rate at some point, relatively low at the other point, and this variation in the egg adoption is really driven by the SEC's decision. All right. It's not anything specific related to an industry. So we can exploit this and we can include the industry fixed effect to control for any industry innate characteristics. Okay. So this is our main model. Again, we focus on the cross-sectional differences in the loan cost and try to relate that to the egg adoption either by the borrower or by the peer. Okay. The first main result, we do find some impact on the egg adoption. If more of the peers in the industry, they have already adopted Agger by the time of the loan, we do see a reduction in the loan cost after conditioning on the common loan characteristics and borrower characteristics. Okay. So this is saying that even if the loan they are issued, right, they're issued in the same time, if the borrower's industry has more peers adopting Agger already, the borrower will enjoy a little bit lower loan cost after factoring into their observable characteristics. So we say that we based on this finding, we say that it seems that right? The increased dissemination of filings can reduce the price protection demanded by the banks because this cost component is after the bank has already considered the observable characteristics of the borrower. Okay. In contrast, if we're looking at the borrower egg adoption, we don't seem to find much activity going on. And this is consistent with what I said earlier. Without easy access to the filing in the public domain, bankers can always try to give a phone call to the managers to get the information anyways. So it might not be too important for whether the banks will be able to get the filing in the public domain or not. But for peers, banks do not necessarily have relationship with the peers, so the public availability of the filings could be potentially beneficial for the banks. And here we do see a price reduction in that sense. Okay. All right. So any questions, any comments so far?
Hi, Alvis, can I ask a question?
Right. Sure.
So I think this is a very interesting paper. I'm just wondering if the mechanism is more like the search cost is lowered after Edgar came into is able to use, and then the loan cost goes down, or do you think there's like it is not a search cost story, but rather the financial information itself is helpful, but it was not almost not available to most banks before the shock.
Right. So before the shock, it was like not available. We term it as like, the filings were very inaccessible, very costly to be able to obtain. But after the adoption of Edgar in this case, it became much easier, much less costly in that sense for the banks to get the information in terms of getting a much wider set of companies' information, right? So we think because of that, the information uncertainty of the banks about the borrower goes down, so they require less protection in terms of pricing. So we try to think about the negative sign here in that sense. All right. Yes, I saw some other hand. Yep.
Yes, hi. Thank you very much. I just have one question. The variation from 3.7 to 8.5% in the beer Edgar, is that because of the like industries or loan maturities, or is there is another factor?
So are you talking about this, or which one are you
The last table, the regression table.
Okay, so can you say that again, your question?
So saying here that the peer edger is associated with about 3.7 to 8.5 decrease in loan spread.
Right.
So the range between 3.7 and 8.5, is that
Yeah.
explained by the industry or the loan maturity, or is there any other factors?
This one, depending on how you view about the variation, if we try to calculate the peer aggregate variation within the industry, I mean, within with the fixed effect or without the fixed effect, then the estimation can be a little bit different. So the conservative estimate is 3.7.
Okay.
The more aggressive one, if right,
Okay.
we want to say, hey, there are larger impact going on, then 8.5 is also something we can obtain, depending on the fixed effect structure. Because in our paper we do try to model it with different fixed effect structure. So that's why the estimate vary.
Okay.
We do look at the other terms later, and I'll show that to you.
Okay. Thank you very much.
All right. So Anshai?
Hi, Alvis. Just out of curiosity question. So, after the ethical adoption, it's also possible that like other investors, such as public lenders or equity investors, may also have better access to information.
Right.
That's why firms may have lower cost of capital in general. So that's why alternative story could be that banks, they just respond to the potential competition with other borrowers or equity investors. So they just reduce the loan spread.
Because like the company, they don't need to just like rely on the bank. They can look at some others sources of financing, right? And there could be other things going on in the public capital market. They might move to the other market, and that might have an impact on how banks are pricing the loans, right? So we do think about this, and then we try to look at the borrowers that do they have a lot of other activities going on? Do we see a change in the composition of the borrowers? So we find that the compositions are pretty similar in terms of the that part. If we try to control for what's going on in the equity market, let's say the information symmetry or things related to the cost of capital side, the effect seems to still survive in the lending market here. So that's that. But we do think about some of the concurrent things that can be happening around this time. Yeah. All right. Thank you. Okay, so this is our main result. And let me talk to you about a little bit more about the other tests that we have. So we do several cross-sectional tests. We also look at how banks are pricing performance of the borrower differently. We also look at how banks are determining the other loan contract terms differently. So for the two cross-sectional tests, here we focus on whether the banks are familiar with the borrower's industry. What's interesting in the banking setting is because bankers, right, they need to diversify their portfolio. They don't just like focusing on all their exposure to one industry. So a lot of time you will see that banks are lending to some industries that they are not familiar with, because diversification will help them reduce or manage the risk of their loan portfolio. So here we are saying that if the banks are going into an industry that they might not be familiar with, they might not have any prior lending in the last 5 years. So this is the particular case where the peer information will be particularly useful. We are trying to see whether this no prior industry lending, this indicator, all right, if the bank doesn't have lending in the borrower's industry in the recent prior, all right, would that magnify the impact of peer aggregate variable in here? And we do see some evidence suggesting that, well, if the bank is not familiar with the industry, they don't have much lending in the industry, in the borrower's industry before, it seems that the peer aggregate effect is particularly more pronounced, okay? The second one that we look at is how comparable the borrower's information is with the peers. So we do look at the comparability. So if the borrower, the intuition is if the borrower is using much more comparable accounting practices, making the banks helping the banks to make more meaningful comparison, okay, then the peer aggregate information might be much more valuable from the bank's perspective. So we try to look at the accounting comparability and then try to see whether it moderate the impact of peer aggregate. And we do see that we do have some indication that the moderation is going on. So if the borrowers, they are using more comparable accounting practices, their information can be more easily compared to the peers. It seems that the peer aggregate variable is more pronounced in this case. All right. So these are the two conceptual tests that we have.
Yeah, question from Philip. Philip, you have a question?
Yes, I do. Can you hear me?
Yes.
Well, my comments relate to the earlier parts of the paper. Would you rather I wait till you get to the end, or would you like to hear them now?
Yeah, anytime. Yeah.
Oh, when I first saw the title, Dissemination of Disclosures, I just assumed the paper would be about management earnings forecasts. And because typically that's what it means. Now, hang on a sec. I think this is a strength, not a weakness, because obviously there are other types of disclosures. So I hope in your literature review, you clarify that you're making a contribution by looking at other sorts of disclosures that what are typically examined. Another comment I have is about industry structure, that in particular, there's a paper by Ali, Classer and Young, 2014, where they discuss some of those effects. For example, in a competitive industry that where the products are fairly homogeneous, a disclosure by one player can be revealing by the whole industry. And the literature on industry or industry structure and product market competition is very relevant. And I hope that the literature review locates a paper within that literature. And also, since you're looking at a new type, well, not new, but a type of disclosure that hasn't received a lot of attention, I hope you also tap into the analytical disclosure literature. Those are my comments. Which
definitely. Our paper is related to the paper is looking at how industry information is being priced in the capital market setting, and then also related to the disclosures you mentioned about forecasts and voluntary disclosures. Here we are mainly focusing on the dissemination of the mandatory disclosures. They are all the disclosures mandated by the regulators to be distributed to the market. So we focus on that part, which is different from the voluntary part. But that is like what you said, and I was like very happy to hear that was the strength of the paper, right? Like we were focusing on some other types of information. But thank you for
You're welcome.
If you can send me the paper that you mentioned, the Ali All paper, and then that would be perfect.
Well, I can send you the reference. I can't send you the paper.
Thank you. Yeah. So in terms of the additional analysis, we do look at the pricing of the performance, whether that will be affected by the change in the dissemination of the peer filings. We do two tests. So here, the idea is if there is an increase in the dissemination of the peer disclosure, we say that might potentially help banks to do the benchmarking. The underperforming borrowers will get penalized, right? If banks can figure out, oh, the borrower is actually underperforming compared to the peers, whereas the overperforming ones will get rewarded. So in terms of like lower loan cost. right? So if the borrower performance relative to the industry, this is like what we are testing, whether they will get more priced in after the egg adoption is greater, after the peer information is much more easily obtainable, right? So we calculate a relative performance variable. We look at the borrower's ROA, subtract that with the industry year average ROA. We try to see whether this relative performance would be priced into the loan contract in much greater extent. And this is what we see, right? So if you look at the relative performance variable, we try to allow peer aggregate, the variable, to moderate the pricing of that performance variable. We do see that the relationship between the relative performance and the loan pricing is stronger, is more negative, meaning if you do better than the industry, you can get more rate reduction, but you do worse, let's say you underperform the industry, then you will be charged more. All right, so this is like one of the mechanisms that we think the filings are helping the banks. Another way to think about how banks might be able to use information to price the borrower's performance. We try to decompose the borrower's earnings into two components. One component is an industry component, the ROE that can be explained by the industry conditions. Another component is the firm-specific component, where the borrower's performance, that part of the earnings is not related to the industry conditions. It's specifically related to the firm's operations. All right. In terms of how we decompose the earnings, we try to regress the borrower's earnings on 4 moments of the peers, the industry's ROA. All right, the part that can be informed by the industry is the predicted the predicted part of the borrower ROA using the above regression. That part is the ROA that can be informed by the industry. The residual is the part that is not that cannot be informed by the industry. So we try to see how the peer aggregate variable will moderate the pricing of each of the two components of the ROA. If we try to focus on the part of the ROA that can be informed by the industry, we do see that the pricing of that becomes more pronounced if we have more peers filing on the aggregate. Whereas for the next part, right, the part of the ROA that is not informed by the industry, you cannot use the industry conditions to inform the ROA of the borrower. For that part is not related to the peer aggregate variable. So this particular result gives us some additional confidence that the peer aggregate variable is giving. The peer aggregate adoption is giving banks more information at the industry level and help them price the borrower. And ultimately, potentially, the reduction in the uncertainty of the banks about the borrower will help them lower their price protection. Okay. And in terms of some additional analysis, I have 2 more. One is looking at how banks are allocating funds across industries differently. The other one is whether the peer aggregate filings, the increased dissemination of that, would that have an impact on the loan characteristics? Okay. For the first one, the idea is if the information of the at the industry level is much easily obtainable, banks might be more willing to allocate more funds to those industries. So let me give you one example, right? Let's say in 1993, Q3, we are talking about JP Morgan. Would they allocate more funds to the communication industry because the industry has a higher egg adoption rate compared to the other industries, right? These other industries would have a lower egg adoption rate. So we are trying to look at the regression here at the bank level. So it's not at the loan level anymore, it's at the bank level. So for JP Morgan, would they allocate more funds to the industry communication industry, let's say, in year Q3, 1993, Q3? whether this share of the funds allocated to the industry, would they depend on the industry ag adoption rate after controlling for bank fixed effect and then the industry fixed effect, okay? We do see some more funding going into the industries where the ag adoption is higher. If there are more firms, industries adopting agri, it seems like banks are more willing to allocate funds to those industries. All right, so it seems like the amount of the funding is also changing and related to the ag adoption in here. After looking at the share of funding allocated to the industries, we also look at the terms of the loan contract. Okay, apart from the pricing of the loan here, in the main test we focus on the drawn amount of the loan. So that if we look at the undrawn, which is the column 1 in here, we do see very similar results, which is expected because the undrawn and then the drawn part of the loan spread, they are highly correlated with each other. More interestingly, if you try to look at the non-price loan contract terms, let's say maturity. Earlier we got some comments on the maturity part. If we look at the covenants and in particular the accounting covenants, we do see some additional changes that are related to the peers ag adoption. All right. We do see that banks are more willing to lengthen the maturity, so they allow the borrowers to pay back, you know, later. All right, so this is like consistent with an information story. If banks are less concerned about, you know, having lower uncertainty about the borrower, they might be willing to lengthen the maturity. We don't see a lot of activities going on in terms of whether the banks will require collateral. All right, so column 3 looking at whether the loan is secured by any collateral. We don't see much. In terms of covenants, we also don't see much activity going on. But in terms of the composition of the covenants, we do see that banks are more willing to use accounting covenants than other covenants. All right. So conditioning on the same number of covenants, we do see an increase in the proportion of accounting covenants. And one of the explanation could be, well, if you try to write some covenants with the borrower, if the banks are trying to do that, they need to know the accounting threshold, right? Let's say writing this minimum EBITDA covenant. They need to know, okay, roughly how well the borrower is going to perform, right? How well the borrower is going to perform depends on the industry conditions and depends on a lot of the competitive composition of the borrower in the industry and things like that, right? So here we are saying that the bankers, if they can understand the industry information better through the peer filings, right? They are more willing to write a contract with accounting covenants because some of these accounting thresholds would depend on the banker's understanding of the industry. So that's why we see a positive coefficient in here. Okay. All right. So these are the main results that we have. Are there any comments or suggestions before I conclude? All right. So we do a lot of different robustness checks. We use different ways to measure peer ag adoption. We also pay a lot of attention to how we control for the borrower size because the size factor is really the driving factor behind the SEC treatment assignment rule. Okay, so we pay a lot of attention to that. As I said, we also control for what's going on or what could be going on in the stock market side at the industry year quarter level. We look at the returns, we look at the industry, the information asymmetries and things like that. We also try to use some other alternative estimation model because a lot of time if you try to look at the loan cost only, you know, in an isolated way, it might not be enough because loan contract terms can be determined simultaneously. So we use the similarly unrelated regression to model all the terms, you know, together. Seems like the results we still go through. We try to address some other explanation. One explanation is maybe the borrower themselves are learning the peers' recent loan transaction. If they can go to Edgar, try to click on how well the peers are getting their loans, right? Let's say if I try to look around and then I try to, I can see the one peer is getting a loan that is a way lower spread. I can use that to argue with my lender and then, hey, look, why don't you also give me a lower loan, right? Lower rate loan. We do try to look at whether the borrowers has a lot of recent peer loans going on. And if we try to exclude these peer loans from the sample, we are okay. Or if we try to control for the peer loan spread in the regression, our results still go through. So we think it's not this sort of borrower learning from the peers recent loan transaction. We don't think that is driving our results. We also do try to address some other explanations, but for the time's sake, I will try to conclude here. You try to take away from today's presentation. I do want to highlight some spillover effect coming from the public disclosure side, going to the private debt side, considering how big the amount of funding coming from the banking sector. We think this is speaking to the economic consequences of public disclosure regulations. Okay. We also do see some additional spillover effect in the sense that the peers disclosures can potentially be useful in terms of assessing the quality, the creditworthiness of the borrower. This is also another type of spillover effect that our paper is highlighting. And the effect is nuanced. As I said, it can help lower the price protection piece, but it can also moderate the pricing of the performance, leading to higher or lower performance depending on the performance of the borrower relative to peers. Okay. Banks are not immune to the information acquisition costs. We got some early comment about disclosure acquisition costs. In the literature, there's a strong notion about banks being able to communicate privately with the borrowers. So a lot of time, people tend to think that, well, the public disclosures do not matter for banks. We do highlight that this might not be the case because we do see that if peers are disclosing more, it seems that banks will be able to benefit from that information from the public domain. Okay, so here we conclude that banks might not be immune to the disclosure acquisition cost, even though they can communicate privately. Okay, so thank you so much. I was very glad to get the invitation from Mohammed, and it was a pleasure hearing your comments and suggestions. Okay.
Thank you very much, dear Professor Alvis Lo, for your contribution and your effort. It's really an excellent presentation and excellent paper. Thank you very much. And thank you everyone joining us today. Thank you. And thank you very much, dear Professor Alvis, for taking the time to present to us today. It's been appreciated.
All right. Thank you.
Yeah. And I hope to see you soon in Egypt. You are very, very welcome.
Yeah. Cairo, next time. All right. Bye.
Yeah. Goodbye.